Friends, I welcome you all to our today's session. Last session, we have discussed about frauds and errors. We have understood how the frauds and errors, if they're material, can affect the truth and fairness of the financial statement. Accordingly, it may lead to a situation when auditor may be issuing a modified report. That means auditor may say that financial statements are not showing true and fair view, or subject to certain things it is showing true and fair view. This kind of opinion are possible in case there is a misstatement which may arise due to fraud and error. So friends, if today I'll summarize what we have learned so far. We have learned that a financial statement has to be prepared. And who is going to prepare this financial statement? Who will be preparing this financial statement?
Sir, the organization.
The management.
The management is to prepare the financial statement. How he has to prepare? He has to prepare within the financial reporting framework. Okay, we know that he has to prepare as per the financial reporting framework. It is entirely his responsibility. And auditor has to give an opinion whether it is showing a true and fair view or not. Okay, and we have to understand, or we have to appreciate one thing, that the financial statement will not show true and fair view if there is a material mistake. Okay, if there is something wrong and which is material, if there is material mistake. So if there is material misstatement, the true and fair view may be affected. So you have to see if there is a misstatement at all. If it is misstatement, is it material? If it is not that material, then doesn't matter. Still, financial statement may show it true and fair view. But in case there is a misstatement and the misstatement is material, then financial statement may not be showing true and fair. So first we have to identify what is the misstatement. Then we have to see if it is material or not. And this misstatement may arise due to two reasons. One is error, and other one is fraud. Okay, so because of error and fraud, there is a possibility of misstatement, and that misstatement may be material. If it is material, it may affect the true and fairness of the financial statement. Accordingly, opinion of the auditor may change. That is the reason. Okay, now at this stage, what we are going to know, broadly we have understood that errors are normally unintentional and fraud may be intentional. And today we are going to understand various types of errors and frauds and what is the situation that may lead to this type of errors and fraud. Let us understand those things now. Please have a look at the screen now. Now you see, here I am showing you one classification about the errors and fraud. Both are classified like this. First of all, you see, one way we can classify them. We can call some more errors as the self-revealing errors and some maybe non-self-revealing errors. Second is there can be unintentional error or intentional error. Errors and frauds can be unconcealed or concealed. And again, there might be some errors and some frauds which may be affecting our general ledger balance, that means accounting balance. Or there might be some errors and frauds which are not affecting general ledger balance. We may call them as procedural errors. Account balances are correct, but there is some error in the procedure. These procedures are not followed. Okay, this is one way of classification. Okay, one by one, let us understand what is the meaning of this thing. When I say self-revealing errors, that means error is such, the nature of the error is such that automatically this can be found out. Suppose if one part of the entry is posted in a ledger and other part is not posted, missed out. In that situation, automatically it will throw a difference in the trial balance. Is it? You can say it is self-revealing. Automatically trial balance will show there is some error. right? So omission to post a part of the journal entry is an example of self-revealing error. Or let us say there is some wrong totally at the time of reconciliation that may be found out. That's also an example of self-revealing error, right? Failures to record cash withdrawals or deposits. Let us say cash is withdrawn, but you have missed to record it. At the time of bank reconciliation, one can find it out because that will be posted in the bank's bank account. So that is also self. Or inter-party wrong account. When party reconciliation will be done, that will be revealed. So these are some of the examples. Well, errors can be automatically revealed. One can find out this. Understood, friends?
Yes, sir.
But if error is such a nature that it cannot be revealed automatically, so we can call them as non-self-revealing errors. Okay. Right. Now, friends, one more way of classifying these errors and frauds are the intentional or non-intentional errors and frauds. First, we'll see what is intentional. As you know, normally we understand that errors are unintentional, frauds are intentional, but there might be exception in both the cases. So these are some examples you see, which are, you can say, intentional. Let's say fraudulent financial reporting. That means financial statement is prepared and it is reported in a fraudulent manner. There is a fraud in it. Example, manipulation, falsification, alteration of accounting records. Accounting records are manipulated. Let us say salary is paid 10,000 rupees, but it is booked as 15,000. Falsification, false entries are made. Actually, money has not been spent, but entries are made. Or alteration of accounting books. Originally sales was for some amount, but later on it is changed to some different amount. So these are the situations where you can see that fraud is involved. We say it is an example where there is fraudulent financial reporting. Okay, or fraudulent financial reporting may also happen when there is misrepresentation or intentional omission of events, transactions from financial statement. There is an event, but intentionally that is omitted or that is misrepresented. Okay, that is misrepresented. Then it is, you can say, fraudulent financial reporting. Okay, suppose the entity has received a notice from income tax department with a fine, but in books of account that has been totally omitted. No liabilities has been created for that. So this is an example of intentional intentional omission. You are knowing there is a liability, but you are ignoring that. Right? Or misrepresentation. Actually, let us say some expenditure has been incurred. Let us say expenditure has been incurred to construct a building, construct a room. You can say that's a capital expenditure. It should be accounted as an asset. But instead, it is booked as a repair maintenance expenditure. This is an example of misrepresentation. That means capital expenditure is misrepresented as a revenue expenditure. If you do so, its impact is that assets are understated, profits are also understated. Is it not? Understood?
Yes.
Yes, sir.
Okay. Assets are understated because you constructed a room, but you are not showing it as a build. You booked it as a repair and maintenance expenditure, so your profit is reduced. Of course, you will be paying less tax because of that. But that is a misrepresentation. Assets should have been booked. Depreciation should have been charged. All these things happened because of this misrepresentation. Then intentional misapplication of accounting principles. You know accounting principles are like this, but you are intentionally misapplying that. Okay, so you know that revenue is to be recognized when the risk and reward associated with the goods is transferred. You know, but you are misapplying. Actually, goods are not sold, not delivered. Actual risk and return is not transferred, but still you are booking it as a revenue. You are aware of accounting principle, but you are misapplying. Or closing stocks needs to be valued at cost or net realizable value, whichever is lower. Okay, but you have valued at, let us say, cost only. So this is an intentional misapplication of accounting principle. Understood? Intentional error. Are you getting
Can
me?
you explain once again?
This last example?
Yes, sir.
Misapplication.
Intentional misapplication.
Misapplication of accounting principle. Now you see, accounting principles are something which you need to follow. That means your generally accepted accounting principle or gap, what suggests you need to follow. How that can be misapplication? There are many areas. So this accounting principle suggests us how transactions need to be recognized, okay, presented, disclosed. All these things are in how it is to measure. All these things are there in your accounting principle. Misapplication can be in many areas. Okay, suppose let us say you are preparing a cash flow statement. In the cash flow statement, this you have to activity-wise classify the cash flows. Let us say investment activity, operating activities, financing activities. But let us say you are wrongly classifying your investment activities into financing activity. It is misapplication. Or let us say simply you are valuing inventory or closing stock in a way which is not acceptable accounting principle. Okay, accounting principle says you have to value it at lower of cost or NRV, cost or net realizable value. But you are valuing it at cost. For some reason, you may come with some excuses that net realizable value is not possible to compute something. So is it not an example of misapplication of accounting principle?
Yes, sir.
Or you may think, let us say, revenue has to be recognized when risk and reward associated with the goods are transferred. Now you have to interpret when risks are transferred, returns are transferred. Suppose you are selling a TV. But practically, let us say you have raised the sale bill, but goods has not been transferred. TV is still with you, but invoice is raised. But TV is still with you. Suppose today the TV will be damaged. Whether the customer will pay, customer will bear it, or you are going to bear. TV is still there in your showroom. You have not yet delivered. Tell me practically what happens in this situation.
So we will bear like
We might have to bear the cost.
Shopkeeper will bear, is it not?
yes, sir.
Let us say customer had come, customer has paid, customer has taken the bill. That means goods are sold. But risk and reward is transferred. Or TV is still in your showroom and risk and reward is still there. If there is a risk, that is yours. If there is some reward, that is also yours. Yes or no?
Yes, sir.
Yes, sir.
So the TV is destroyed means you have to give him another TV. And at that time, let us say you are booking it as your revenue, as your sales. Is it not a wrong application of accounting principle?
Yes, sir.
Risk and reward is not transferred, but you are booked. Okay. So this may be an error, maybe a fraud also. Right. So these are some of the examples. Now, friends, again, you see, this intentional errors and frauds can be with regard to misappropriation of assets. First thing is that this A category, you can say fraudulent financial reporting. Under this, these are the possibilities. Similarly, misappropriation of assets. Assets are misappropriated. For example, let us say cash is misappropriated. Office cash. My office has got cash. Cash balance is there in my office, but I am personally using it. Okay. Cash is in my pocket. I am personally using it. That is misappropriation of cash. Misappropriation of goods. My office goods are misappropriated. Office has given me a vehicle, but I am using it for my private use. Right. Or some entities, some businesses, goods are consumed by me. That is misappropriation of goods. Then misappropriation of accounts to manipulate tax, dividend, remuneration. These are again some situations. Accounts are manipulated to minimize tax. Okay, profit might be reduced so that tax will be less. Sales might be hidden so that GST payment will be less. Without bill, goods can be sold so that GST payment will not be made. And also it affects dividend. Suppose a company may not be willing to pay more dividend. It may purposefully show less profit. And it may misappropriate accounts. Or company wants to pay high dividend. It may purposefully do accounting in such a way that profit will be more. Sometimes these profit figures, sales figures are related, or let us say, there is some relationship with the remuneration. Let us say if this much of sale is achieved, a bonus will be paid to sales staff. Okay, or some commission will be paid. And in order to show that thing, accounts may be manipulated. Suppose there is a target. If your sale reaches 5 crore, and bonus will be given and 2% commission will be given to the sales team. So there is a possibility that the sales figure might be manipulated to earn this remuneration. Understood?
Yes, sir.
Yes, sir.
So these are the possibility of misappropriation of asset, intentional for error. Now, friends, look at this chart. Here we are trying to analyze frauds relating to defalcation of cash. How there is a possibility of fraud, and under this category, defalcation of cash. First, you see we have classified it into 3 parts. First one is by inflating cash payments. That means I am manipulating cash. Let us say office cash I am using, or a particular employee is using. How he can do it? By inflating cash payments. Actually, he is using cash, but in the books of account, he'll show that the cash is spent. That means some cash has been paid. How? Making payments against fictitious vouchers. He'll make some fictitious vouchers. Meaning, actually money has not been spent, but vouchers he'll prepare. Fake vouchers. He will get inside and put some fake bills. Secondly, inflating the amounts in payment vouchers. Inflating means actually payment is for 10,000 rupees. He'll write it 12,000 rupees. That means voucher is okay, but the amounts are inflated. Third example is that manipulating wage roll. Suppose laborers, payments are made to laborers. There are 100 employees, 100 laborers, payments are made. Everybody has signed. This, let us say, fraudster, the employee who is committing the fraud, may add 5 more employees. So he is manipulating the wage roll. So he's including some dummy workers. In this way, that person or that fraudster may manipulate the cash, defalcate tax, or misappropriate cash, or casting larger totals in petty cash expenditure. Petty cash expenditure, as so many expenditures are incurred. So purposefully, the total is 5,700. We write 6,700 and carry it forward to the next year. Next page to as 6,700. Assuming that so many items are there, nobody is going to cross-check it. Nobody is going to cross-total to find out where there is a mistake. So this is again one more trick, casting larger totals in the petty cash expenditure. Okay, petty cash expenditure, mostly totaling is done manually. Therefore, one might do it. In case of computerized totaling, people normally do not adopt this kind of thing.
So can you explain the third point again?
Manipulating wage roll. Third point you're talking about this one. Manipulating wage roll means wage payments are made. Okay, suppose payments are made to the daily workers. Right. Suppose 100 workers are paid. So how you will be paying? So it will be take a piece of paper and ask them to put your signature, thumb impression. Total is this much, one voucher is passed from that. Okay. Right. So 100 people have signed. Then the fraudster may add 5 more names. So he'll show payments are made to 105 workers. Understood?
Okay, sir. Yes, sir. Got it.
So these possibilities are there. So these are some techniques fraudsters adopt. By doing that, they defalcate cash, misappropriate cash. Last item I told you, there's such a wrong totaling of the petty cash expenditure. Okay, so practically I have seen in particular company, there is a fraud where that person, what he had done, he was showing an Excel sheet to get approval. Suppose monthly commission has to be paid. Okay, monthly commission and sales team has to be approved by the MD. Right? Okay, so what that person was doing, that in Excel sheet he was typing the names and finally arriving at the total amount. In between, he was hiding some rows. Certain rows were hidden. Okay, and he is showing it to the MD. You see, this is the amount to be paid to different persons, and total is this much. MD was checking it, and MD was giving a check for that much amount, whole total amount. After that, he was unhiding the cells, unhiding the rows, and finally, let us say in that hidden rows, there are some names were there. The money was also transferred to those people. Understood what I said?
Yes, sir.
This is practically I have seen that. Okay, very easily you was committing. Understood what I said? Or you want an example? Or you want a demo?
Understood, sir.
Understood now? He was hiding some rows and total amount he was getting, and MD was giving direction that much money was transferred to the bank. And after that, he was unhiding. So he was getting the benefit out of this. But MD was knowing only, let us say 10 people are paid. 10 people MD was signing. But actually, it was paid to 12 people or 11 people. Okay. Understood that example? Yeah.
Yes, sir.
Right. Now, this is how inflating cash payments one can misappropriate cash. Then coming to second category. By suppressing receipts, that is, receipts are suppressed. First case, cash payments are inflated. The receipts are suppressed. How they are suppressed? One method, popular method, that is called the teaming and lading method. What is the teaming and lading method? Money received from one customer is misappropriated, but he is subsequently credited with the payments received from another customer. Okay. And in this process, no account is kept outstanding for a long period, raising any doubt. So nobody was doubting the situation because no amount was kept outstanding for a long period. What happens in teaming and lading? Let me tell you. Let me try to explain once again. Okay, so let us say money is received from A, that is misappropriated. Let's say I am the cashier, I'm using that. I will not make any entry. I will not show that it has been received. But tomorrow I will be receiving money from B. Okay, when I will be receiving money from B, this A's money I will see as if I have received. Now B's money is my pocket. I am not accounting. I will not show. Next day when C is paying, I will be making B's in. Understood? When C is making payment, I will say, okay, I will state as if B has paid. Next day, when D will pay, then I will be making C's entry will be made in the books of account. In the process, at any point of time, let's say there is a surprise visit, we will see the last person money received has not been accounted. In that case, this accountant will say, we only have received the money just now. I am about to book it. Maybe in 1 or 2 days, I will be booking it. This method is called the teaming and lading method. Understood what I say?
Yes, sir.
Okay, so this is one of the methods through which one can commit fraud by suppressing the receipt. Teaming and lading method, you see. money received from one customer is misappropriated, but he is subsequently credited with the payments received from another customer. No account is kept outstanding for long period, raising any doubt. Nobody will doubt. When the customer will ask whether I have received the payment, yes, his payment is there. When the customer asks the balance, he can see his account, his money is already recorded. That is one way of suppressing this. Another way is booking fictitious rebates or discounts. That means actually discounts are not given, but in the books of account, discounts are recorded. That means full money is collected from the customer, but it is shown in the books as if discounts are allowed. Third example is that writing of debts. So from the debtors, let's say money is collected from debtors. Money is collected, but in the books of account, the debtor balance is written off. So whatever money is collected, that is manipulated. Understood? Then not accounting cash sales. If sales is made through, let us say, cards or through banking channel, then it's not easy to hide that sales. But cash sales, one may manipulate. So sometimes there are possibilities that the cashier may not be accounting cash sales. Goods are sold, but cash is not. Similarly, not accounting of miscellaneous receipts. Money is received from miscellaneous sources. Let us say scrap items are sold, some money is received. And they are not accounted. Not accounted means they are misappropriated. Then one more example is writing down asset values in entirety and selling them subsequently and misappropriating the process. That means assets are written down entirely. Okay, so I will say, okay, my computer is not working. It has gone, it is already old. Let me write it off. Remove from fixed asset register, remove from the books of accounts. After that, I'll be selling it to somebody and get some money. This technique is called as writing down asset values in entirety and selling them subsequently and misappropriating the process. Understood? Understood all these techniques?
Yes, sir.
Now, thirdly, one more way is that is by casting wrong totals in the cash. Earlier, we are discussing about casting wrong totals in the petty cash book. Now, here we are talking about casting wrong totals in the cash. In the cash book itself, wrong totals are made and the difference money is misappropriated. So these are some examples of fraud that may be committed under this category, misappropriation of cash. Now, okay, cash misappropriation you have understood. There is also possibility that goods may be misappropriated. So under this category, misappropriation of goods, you'll find that these are the frauds which are difficult to detect. Okay, it's quite difficult to find out whether goods are misappropriated or not. For example, let us say cash is misappropriated. You can check the cash book. You can try to find it out. Let us say certain goods are misappropriated. Let us say someone is using office vehicle for private purpose. It is little difficult to find out that. Or let us say office business assets are sold, and the money is used by someone personally. Then it is little difficult to find out. Okay, so for this situation, what happens? Management has to rely on some measures, that means some internal control systems there, so that the techniques will help to detect or to avoid this kind of frauds. Okay, some control measures needs to be taken, like physical access control. That is, everybody should not have access to do a particular thing. Periodic checks, that's a periodic physical verifications of periodic checks, or intelligent ratio analysis. From ratio analysis also one can find out. Suppose inventory is misappropriated. So your gross profit ratio, one can find it. That may show a low ratio. That means something is wrong. Some wastages are happening. Or input-output ratio, one can find out. With this much of input, output should be this much. With 100 kilo input, output should be 95. If output is 94, there is a possibility that 1 kilo is misappropriated. So by doing this kind of intelligent ratio analysis, one will be also able to find out fraud. Fraud as regards to misappropriation of goods. Understood, friends?
Yes, sir.
Yes, sir.
You see, one more kind of fraud. This is about manipulation of accounts. When accounts are manipulated, that means purposefully someone is trying to change the accounts. And this type of fraud, normally one finds that higher management is normally in. That means this fraud is happening under the direction or with the knowledge of the higher management. Higher management might be saying, okay, I want this much of profit, you do one thing, you reduce the sales or book some expenditure. So this is a fraud involving manipulation of accounts. And higher management is involved in this kind of situation. Now you might be thinking, why at all higher management be willing to do this kind of fraud? There are reasons, many reasons. Number one, maybe to avoid tax, or maybe to take a decision to declare dividend. Suppose shareholders are expecting dividend and company is not in a position to declare dividend. It's not showing profit. So they may manipulate the account in such a way that it will show profit so that dividend can be declared. Or reverse situation. Company doesn't want to declare dividend. So they may manipulate the accounts in such a way that it will show that sufficient cash flow is not there to declare dividend. So to declare dividend or to withhold the dividend declaration, accounts may be manipulated. Or to manipulate remunerations payable on profit. Let us say certain commission is paid on the basis of as a percentage calculated on profit, or some other kind of remuneration, which depends upon some of the financial figures. So to manipulate that remuneration, accounts may be manipulated. Okay. So by inflating, deflating expenses, closing stock, incomes, assets, liabilities, outstanding liabilities, prepaid expenses, changing revenue to capital, and vice versa. By doing all these things, frauds can be committed. Okay. Understood the types of fraud, intentional, unintentional?
Yes, sir.
Right. Now, here is again one more category of error or fraud, concealed or unconcealed errors. As you have been telling me from the very beginning, some of you had told me that mistakes are generally unconcealed and frauds are concealed. But there might be exceptions. Sometimes what happens, the fraudsters, they purposefully do not conceal it. They keep it open, with the hope that if things will be open, people will say it is, people will feel it is not a fraud. Okay, it is not a fraud. Otherwise, it would have been concealed. So purposefully, sometimes people may keep the fraud open. Sometimes it's smart fraudsters, they keep the things open. After that, they can claim, no, it's not at all a fraud. I have kept it open. I have disclosed everything. Okay, so frauds may be unconcealed. And mistakes may be concealed. Sometimes people conceal mistakes. So there are possibilities of exception. Now, friends, this is one more type of error which is referred to as procedural errors. Okay. Okay, the process of accounting involves both, that is record keeping as well as following procedures. If records are kept properly, that means entries are made properly, that means financial figures are right. Okay. Procedures are established to maintain control over resources and transactions. If a particular procedure is not followed, that means there is a breakdown in the procedure, which may lead to some error. Let us say accounting is made correctly, but procedure says a voucher has to be signed by 3 people. That's the process. That is the process. Person who is preparing it, person who is approving it, and the person who is making it. But you are finding this process is not followed. Only one person is signed. So that is a breakdown of process. And tomorrow it may lead to some error, and there may be possibility of fraud also. Okay, so these situations may be referred to as procedural errors. A particular procedure has not been followed. Transaction is over. Okay, friends. Understood?
Yes, sir.
Now you see, there is one more way we can classify the errors technically. As you can read it, I have classified into under again 5 more categories. Please read it. What is first one?
And the first one is error of omission, omitted wholly or partially.
Second one is error of commission. Transactions are misrecorded wholly or partially. Then compensating error. 2 or more errors exactly counter each other. Fourth is error of principle. And 5th is procedural errors. So one by one, let us quickly discuss these things. Right. And yeah, before that, we'll talk this thing. Okay, let me first discuss. When I say error of omission, that means a transaction is totally omitted, not recorded. Sales has been incurred, but it is not recorded in books of account. It's an example of omission. When I say commission, what happens? The transaction is partially recorded or misrecorded. For example, salary is paid and on which tax has been deducted. Salary part is accounted, but TDS part, tax deducted at source, that has not been recorded. That's an error of commission. Or salary paid for 5,000 rupees, but entry is made for 4,800 rupees. Transaction is misrecorded. That is also an error of commission. Then compensating error means 2 or more errors exactly counterbalance the effect of each other. One mistake is there, but there is another mistake, which is counterbalancing its effect. Okay. Understood? Suppose goods are sold to Ram. So Ram's account should have been debited, but by mistake, some other person's account is debited. So Mr. X account is debited. It's a wrong entry. But after some time, what happens? Goods are sold to Mr. X, but instead of Mr. X, Ram's account was debited. So effect is same. First, Mr. X account should have been debited, but instead of Mr. X, Ram's account was debited. It is wrong, but next time it got changed. Instead of Mr. Ram, Mr. X account is debited. Understood? So this is an example of compensating error. Right? Then the next type of error is error of principle. As we are discussing, that accounting principles are not followed. And procedural errors means there is a breakdown in the procedure. So this is also one more way in which errors can be classified. Now, friends, having understood that what is error and fraud, and also having understood that why we are learning about the error and fraud is that this error and fraud may lead to a misstatement. If it is misstatement, then no issue. If it is amendment, But it may lead, if it is a material misstatement, then auditor's opinion may change. We have understood the concept of materialities, and we have to think, we have to decide whether this misstatement is material or not. So in essence, the financial statements should not be materially misstated. Okay, otherwise it will not be showing true and fair view. Okay, with that, this background, then we will be learning one thing. From the very beginning, we know that it's the management's responsibility to ensure that the financial statements are showing true and fair view. So in that context, let us read some of the provisions of SA 240, Standards of Auditing 240, where in one paragraph we'll be able to appreciate that whose responsibility is it to ensure that the financial statement is showing a true and fair view. And what is the duty of the auditor if it is not showing true and fair view because of a misstatement which arises due to an error or fraud? So SA 240 says the primary responsibility lies with those in charge of governance. Okay, so those in charge of the governance are responsible, and in addition to that, it is also the responsibility of the management. So management, as well as the people who have the responsibility of governance of the entity, they are also responsible. And as an auditor, auditor's responsibility is to obtain reasonable assurance that the financial statements are free from material misstatements, whether caused by error or fraud. This paragraph is important for us. So when we are auditing, we have to obtain reasonable assurance that the financial statements are free from material misstatements. And this material misstatement may cause due to either error or fraud. Now we have understood whether there is error or fraud. Then we'll see if there is a misstatement, if it is material. Then we need to get reasonable assurance that it is free from those kind of errors and frauds. Auditors need to appreciate that risk of not detecting a fraud is higher than the risk of not detecting an error. Is it not? It may be easy to detect an error in a normal audit procedure which are followed by the auditor. Most of the errors are detected. But it's not that easy to detect a fraud, because in case of fraud, what happens? The incident may be carefully concealed. And auditor also understand that is one thing. Risk of not detecting fraud is higher. Then in the area of judgment, auditor always try to see that there is no misstatement. But when judgment areas are involved, let us say life of the asset, it's a judgment area. But whether the debtor will pay me or not, how much should I provide for bad debt? It's a judgment area. It is difficult to detect a misstatement in judgment. Okay, it's not a simple transaction. It's a transaction where a judgment is. And one more thing, management fraud is difficult to detect than employee fraud. Fraud which is committed by the management itself or the superior positions are, let us say, committing a fraud, then it will be difficult to detect. Understood?
Yes, sir.
Okay. Right. So auditor needs to get the reasonable assurance that the financial statements are free of material misstatements. Risk of non-detecting a fraud is higher. Difficult to detect misstatement in the judgment areas. Management fraud is difficult to detect. So with this background, how auditor will be handling the situation? He is expected to maintain an attitude of professional skepticism throughout the audit. He needs to be skeptical professionally. His attitude should be like that. That means questioning mind, not exactly being suspicious to the situation. He need to question why this is happening. Why he needs to be skeptical? Because he has understood this, these are the problems. If there's a management fraud, it will be difficult to detect. Okay. And there is always a risk of not detecting a fraud. So auditor need to consider what is the potential of the management overriding the controls. Let us say control mechanism is there. So procedures are there which will be controlling the fraud, controlling the misstatements. Okay. So auditor needs to maintain the attitude of professional skepticism, considering the potential of management override of controls, and recognizing the fact that audit procedures that are effective on recognizing error may not be effective in detecting fraud. That means the procedures, audit procedures which auditor is applying, they may be very good in detecting an error, but may not be effective in detecting a fraud. Because a fraudster normally plans it. And he plans it keeping in mind the normal audit procedures. He knows, okay, auditor will be verifying in this manner, so let me commit a fraud in such a way that auditor will not be able to find it out. Okay. Let us say fraudster knows that considering the volume of vouchers, auditor will be checking it for 2 months or 3 months voucher, it will be checking. And in that case, it is difficult to ensure that entire fraud will be detected because 100% checking is not happening. And that is also not auditor's process. Auditor has applied it, auditor has, let us say, implemented a procedure of sample checking. In that case, fraud may not be detected. So auditor's normal audit procedure may not be effective in detecting a fraud. And when coming to fraud, you can see fraud can be again in 2 areas. In the area of financial reporting. Secondly, with reference to misappropriation of assets. Okay. So these are the 2 areas. And there are certain circumstances which will indicate the possibilities of fraud. If you talk about the circumstances, you can see these 3, the bottom part, these 3 things. There might be incentive or pressures to commit fraud. There might be opportunities. And again, whether fraud will be there or not, it depends upon the attitude of the management and the way the management tries to rationalize his own argument or his logic of committing fraud. Okay, let us discuss about this thing. First thing is that incentive and press. Let us say there is high degree of competition or market saturation, and the company is going to face some operating losses. Company need to obtain additional loan. In that situation, a company would like to show some type of profit, because if profit will not be there, bank may not give it loan. And all its competitors are showing profit. In this company doesn't show profit, that investors will not trust the management. Sometimes profit also needs to be shown as a requirement of compliance agreements, as a requirement of compliances to various agreements. Or there is a possibility of the personal guarantees given by directors against some loans may be revoked. Okay, may be utilized by the banker. That means you are describing a situation. There is a lot of pressure on the company to manipulate his account or somehow to show a good result, good profit. And if they are able to show it, there is an incentive, there is a reward. That loan will be sanctioned. Okay, they'll be able to comply with the rules, comply certain agreements. Direct personal guarantees given by directors will be protected. So this is the situation. If this is the situation, that shows there is a possibility of fraud because there is an incentive, but there is a pressure on the entity to commit a fraud like this to manipulate accounts. Understood this point?
Yes, sir.
Similarly, if there is opportunities, let us say incentive is there, but there is no opportunity, then also company cannot do it. But if there are opportunities to increase profit, to decrease profit, then one would like to do it. For example, if there is significant related party transactions, let's say company is purchasing and selling from its group companies, then they can manage the financial statement. Okay. So then let us say market price of something is 50 rupees, they may buy it at 30 rupees because they're buying from the sister's concern. By doing so, they'll purchasing less than the market price, so the profitability will improve. The other company who is selling will be suffering losses, but after all, it is their group company. So that company's profit is transferred to this company. The company who was already making profit will share some of the profits to other company by selling goods at a discounted price. Or this company who is making loss will be selling something to the other company at a very high price. Let us say a pen is for 10 rupees, it will be sold at 100 rupees. So this company who is selling will be making profit. Other company will be making loss because market price is 10 rupees, but that company is purchasing at 100 rupees. So this company will earn profit, other company will be making loss. That means what happens? The other company's loss is transferred to this company. This company started making profit. This company's loss transferred to other company. So loss-making company becoming profit-making company, profit-making company is becoming loss-making company. So this is possible when there is substantial related party transactions, you can manipulate the price. Okay. Second opportunities are there. Significant estimates that involve subjective judgment and uncertainties that are difficult to corroborate. Let us say the financial statement preparation involves a lot of judgment and a lot of uncertainties. When there is uncertainties, you have to estimate something. In those areas, those judgment and areas and uncertain areas, opportunities are there to manipulate the accounts. Third opportunity is that significant, unusual, or highly complex transaction, where it is difficult to find substance over form. What is reality and what is the transaction, how it is designed, we need to find out. And accounting has to be made on the basis of substance. Okay. Right. So if transaction is so complex, it is difficult to know whether it is what kind of transaction it is. What is this in substance, whether it is in form. So it may appear to be a capital transaction, but actually if you see in substance, it is a revenue expenditure. A transaction is so complex, it is difficult to appreciate whether it is a revenue expenditure or capital expenditure. So these are opportunities to manipulate the accounts. Understood, friends?
Yes, sir.
Lastly, attitude and rationalization. That also creates opportunity for manipulation. Sometimes, or that circumstances also indicates or may indicate possibilities of fraud. Non-financial management's excessive participation. The people who are not supposed to participate in the financial discussion, they participate excessively. That also shows that is something wrong, something fishy. Why these people are interfering with the financial discussion? Then, if the entity has some history of violation of law, that means in the past the entity has several times violated law. That also indicates the possibilities of fraud. But changes in lifestyle that may indicate that assets have been misappropriated. You are noticing the lifestyle of people are changed. Okay, people who are supposed to normally, if you are coming in two-wheelers, suddenly started coming in cars. That may indicate something. So one can get this type of indication from accounting records. Okay, from certain evidences which are conflicting. Two evidences are suggesting two different things. And when there is some problematic relationship, or from other situations also, one get indication that frauds are conducted. So these few other things we'll be discussing in our next session. And with that, we'll be concluding our discussion on frauds and errors. Okay, friends, today we'll stop here. Thank you very much.